All right, ladies and gentlemen, I hope you're having a wonderful weekend. Today, we're going to talk about how we are going to turn this account to $10,000, and we're going to talk about the strategy of how to do it safely, and then also along the lines of a strategy you could use that we've been using to go about making $100 a day. But before we do any of that, please understand option trading is extremely risky. You can't lose off, not most of your financial investment. Please consult with a financial advisor, and this is educational purpose only. But in all seriousness, though, paper trade, and do not try any of this without paper trading and fully understand what's going on. I'm showing you what I have done, what I'm planning to do, and how we're going to go about it. Every single one of you is going to have a different financial strategy, approach, lifestyle, expectations, all that. So keep that in mind. Now, last time I've documented this account and made a video. People said I rambled, yabba, 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 dooba. I tend to do that. I want to make sure you understand it, but I do want to focus more along the lines of the main keys here, the actual strategy itself, and then what not to do. So we're not going to cover the plays, this and that. People want the strategy. Here's the exact strategy, and this is what we're going to cover. I strongly encourage, though, that you understand what this is and what we're going to be talking about, and we're going to be talking about credit spreads. So we have videos on this. If you search advanced Robinhood trading strategy and how I turned $100, hopefully it'll be up here on the recommendation. I'll post them in the links in the description, but these are going to show you how to do this. And also, best thing of all, just come on live. We are live Monday through Friday, 30 minutes before open. So you could come in, ask questions, and take this slow. So what gave me this idea and what's giving me these ambitious notions to talk about this? If you guys remember, this is where a lot of the strategies have started from. Here's this $150. We kept popping it up. We took it up to $1,800. Then it came back down. Even we were just at $500 not too long ago. And then now it's back up to $1,000. Now, the main key that I want to highlight here is doing things safely. This is still the same $100 has lasted us over 3 months. Now, I want to be as transparent as possible with you guys so you see this is the name of the game and the strategy we've been talking about. We've put $700 into this account, but it's not as if I put that all in at once because this is what I've always said. Take it slow. You guys are going to blow up an account. It is hard to trade with a little bit amount of money, but once you see here, once you finally get money, it's what you do with it, and every single one of you is going to run into a winning trade. But the main thing of the strategy we say, put $100 a month, every single one of you, and that's what I did here. I started with $200. We ended up blowing it up. It kept going down and down, and we would add $100 a month, and finally the last $100 that we had in there, that was enough to take us here. And the best part was we haven't gone down since. Now, what's making me say we're going to turn this into $10,000, because this is something I highlighted. As we were buying options and it was coming down here, as I started noticing we were giving the money back, I made it very, very clear the strategy we're going to adopt here to switch it up and respond to what the market was giving us so that we can make sure we preserve this and we don't have to deposit any more money, which we haven't since. And that's the credit spread strategy. So even here, last week, we made about $176. You could see over the last month at one point before this, 2 weeks ago, we were at $500 or even right before that. So both of these 2 weeks, you could kind of see how it's playing out. It's about $200 a week. So again, we are going to show $100 a day. I have a strategy outlined that you could adopt with this. But even then, by going conservative, and this is where I'm trying to give you guys the options, if you go conservative with these, you don't need a lot of money in your account to do it. You could do this again. We did this all with pretty much $500 or less. But the conservative side is going for $200 a week. If you do $200 a week for a month, that's going to be $800 a month times 10 months. That's pretty much saying in under a year, we'll be able to turn this $500 or this $100 into about $10,000. That's the one end. But again, if you have more money, or even if you have less money and you just want to be a degenerate about it and really go hardcore, you could go after this strategy a lot riskier and try to make money off it. And that's the key here, is that this is going to be a lot more safer. But we even did this last week. I'd even want to show you guys this. So if you did want to be risky in your approach, you could do so in a little bit safer of a manner than just straight up buying calls, selling calls, whatever it may be. So the name of the game here is credit spreads. That's what we're doing. Now, you could go debit spreads, but credit will make you a higher probability money. You could ask anybody on Wall Street or anybody with trading experience. They will tell you that the most successful option traders are the ones selling premium. This is just a fact. This is just statistic, because most options expire worthless. And that's the whole point here, is that you are selling premium. So again, I want to get more into the strategy here, but you could watch the video on spreads. And as we go through this, we're going to talk about this more, but that's what you're doing here. And this is the whole point. If most options expire worthless, look at your portfolio. And that's even what we saw here. This is what you'll notice, like even in this last 3 months, during this time, until we started kind of making this bounce back, we were selling spreads, but we literally had to suffer big option expirations. I had to get rid of options that I purchased that were expiring. Those had to flush out. Once we flushed that out the system, we started coming back up. But that's the whole logic here. Most options are 90% of options are going to expire worthless. You want to short them. So just like people will short penny stocks, as you've heard, those strategies, it's literally the same concept with options, but more reliable. But again, there is risks, but if you know how to account for them and have a strategy, you should be good. But what we're going to do here, the key strategy behind all of this is sell credit spreads, aka time. If you heard people sell time, until volatility or news events arrive, and then we're going to buy naked options to pad the stats. So this is where you're going to see some stuff we'll talk about. We're mixing in a safe and slow strategy and sprinkling it with risk. So even though now I have all these credit spreads and we're saying $200 a week, whatever it may be, the whole idea is do this until we could take advantage of events. And that's something we even did here. I bought a debit spread the other day, even though we have a lot of credit spreads here. Actually, these 3 are debit spreads, these 4 here. But as some volatility events started picking up, we could shift to those debit spreads and buy options. And that's where now you could start. Because again, all these pop-ups here, these big pop-ups, we're buying cheap options that did very, very well for us. So that's what we want to take advantage of. But there's that. And like we said, the key thing to understand is that you want these spreads to expire worthless. That's why you are selling them. So if you ever get confused on what a spread is, you're selling an option and you want it to expire worthless. So if you sell a call, you want to make sure that option ends out of the money or cheaper than what you paid for it, because then that way you keep all the money. If you sell a put, you want the stock to go up. You sell a call, you want it to go down, because that would mean the relative option would drop in value. So there's that. And then the next thing to understand, and we'll talk about this as we keep moving forward here, is understand the risk reward, or better yet, the collateral to credit ratio. Understand the collateral versus how much you receive. So it's very simple. Like here, this is that Disney put. We sold a 131 put and we bought a 129 put. The difference between these two strike prices would be $2 or $100 a share times 2, $200. You need $200 collateral, but then we got a credit. So this is what you have to keep your eye on. That's what a lot of people don't get too closely, or they don't understand how that factors into stuff, but we're going to get into that. So now here's the actual strategy. Diversify. This is what you're going to do with these spreads to get some of these returns, or what I've been doing so that you guys can see is getting a different type of credit spreads. It's selling a mix of in the money spreads with lower probability, higher gains, selling some guaranteed high probability, lower credit spread plays, and then some that are pretty much right in the middle. Now, if you want to make higher daily payouts, you're going to focus on a higher credit. So again, if you want to go for $100 a day, even $200 a day, $50 a day, I would be very cautious that we're going to get on what not to do. Make sure you don't go above one contract. Again, don't try to sell multiple to collect higher credit. I really, really caution against that. And again, that is for the strategy aspect, because if you are wrong, there is a way to get out of these. We're going to talk about rolling over and what that means. Essentially, if you want to take a more riskier route, you could go for higher daily payouts, go for the spreads with higher credits, and then just cut them when they're up 30-50%, and then boom, you could get one the next day. And that's something that reminds me here too, you're not going to be day trading these. The thing with credit spreads, it takes time, but don't worry, literally this whole account performance here, we have not used one day trade. So keep that in mind. I mean, sometimes we could have day traded and it would have helped out, but for the most part, when you're selling premium in time, you don't want to do that. But again, now here's the real meat of this strategy is the types of credit spreads you are doing, because a lot of people will sell credit spreads and it's very, very slow. Like, so here's McDonald's. This is a great example of one of an in the money credit spread. I got $185 credit. So think what it means is I collected $185 up front. The difference between these two strike prices, that's $2.50. That requires $250 collateral. But if I collected $185, that's realistically, do the math, 185 minus 250, that's how much I would lose worst case scenario. Because again, this is a defined risk strategy, but here is the key to it. I would benefit off of this because this one is a high credit because it's already in the money. So I sold calls. I sold a 210 call and then I bought a 212 call. So this is where what you do with this spread, you're selling one option and you're buying another. And the difference is by selling this one should have more value than this one. So I sell this for more money. As you see here, I sold this for $4 and then I bought the 212 for $221. And then that that difference in cash is that credit. You keep that. And now if the whole concept here is if this falls below 210, I'll make my money. So you see here, the share price is at 213.16. This expires next week. So this one is deep in the money for the most part. But if McDonald's drops $3 now by end of next week, I will walk away with that $185 credit. And that's how you're able to, and again, this is still a decent play because probability speaking, even though it's in the money, it has a 30% probability, a little higher now actually, because I sold it when it was further. But again, you can't do that all the time, because here's the thing: if you're selling in the money credit spreads, you're going to get higher credit, even regardless of the collateral, because now the collateral is 250. If I'm collecting 185, my max risk isn't high. But here's the thing: if you collect a high credit, that usually means it's going to be harder for you to win and make the full amount of money. The higher the credit, usually the higher the risk. That's why if you want to go here, this is why we even say here now, you got to mix it up. You could go for some guaranteed high probability, lower credit spreads. So a good example of that could be Starbucks. And I want to show you guys another one I did on Disney, because that one was a medium spread one, but that one fell out the money. Or that one actually ended up going against me, but you'll see here. But Starbucks is trading at like $88. And Starbucks is very, it's kind of holding this range. Let's say it won't go down. You could sell one super far out the money here. Like, so you could say Starbucks, let's say it's going to drop like $85. So you could sell this for 26, buy this back for 84, and you'd make literally $9 of profit. But that's the thing. You're like, well, why would I do that for $9? Your risk would be $100, because that's the collateral, the difference between there. But you would make about, maybe even 7 to 10. This is the bid and the ask. And that's the thing. When you guys are looking to open a credit spread, you're selling it. So if you want to get filled right away, you're usually selling it at the lower price. If you want to close out a credit spread, you're buying it back. So to guarantee you get filled, you're going to want to buy the higher price. But essentially, you could sell this one, let's say hypothetically, for $10 in the midpoint. You're only going to make $10 on that, but this one would expire next week. But here's the key. This is saying that in Friday, when it won't even move that in a whole week, this is a pretty good odds in your favor. So it's an easy $10. I mean, so you're going to get that money and get paid for that no matter what. And this is where I'm saying, you want to mix this up between in the money, super far out the money, and then now you could even get the ones that are kind of just in the middle there too. That's why I like a stock like Disney, and I have one, and this one was kind of further out the money in the middle. Let me put up Disney by itself so you guys can see here in the last month kind of how it's moved. It even, let's say the last 3 months or year, pretty much, it's kind of held this range here. It's tested around here, but it barely fell off. So I sold one a little bit further out, but it actually ended up going in the money against us. But in general, you could sell ones that aren't super further out, but kind of right there in the middle, that are going to offer a decent credit to collateral. And that's how can you tell how far out the money it is? Usually, or the percentage is going to be based on what is the collateral, but what is the credit you're getting on it. So that is the meat and bones of this strategy. And then again, too, the next level is if you are taking the higher credit ones, you could cut them at 30 and 50% and make a good gain, and then you could close out the risk. The next part now is how do you, beyond finding, how to get good credit and good collateral plays, is finding the stocks that just had big moves and go after those. Sell the direction it's going. It's very counterintuitive, but believe it or not, this is usually the best. But think about what options are. They are insurance, and that's the point. You want to be the one selling insurance when people are scared, and usually when the implied volatility goes up, if you're the one selling the spread, it will work in your favor. Examples are Roku, HD, Walmart, Tesla. We've played every single one of these. So this is our real estate account. I did this for the real estate guys at the office, and I told them about this spread. They did this one as well too. But we sold this one for $55 when Tesla was going up. We sold 250, 252s. These expire next week. But Tesla, after we sold it, it shot up and it pretty much doubled. They were down 100%. Then Tesla came right back down and now it's holding. But watch how Tesla plays out. It looks completely different than the stock. That's what the stock did. But even though the stock shot up, now the premium's going lower. That's going to work in your favor. Same thing, we already cashed out of those plays, but Roku and HD and all those, I like selling all those, not rip. Here's Roku. Roku has been on the decline here. I've been selling puts on all of these instances. When Roku was up, we sold calls. and it didn't go that far, or if we thought it was going to bounce but not bounce too high, like here, we sold calls. But in general now, the premium on the puts are going to be high. Believe it or not, even if you sell the direction the stock is going, you're usually going to be able to do good if you're selling the premium. And again, if it goes against you, the point is your risk should be capped. But now this is how you're able to find certain stocks. Or if you're like, okay, well, what credit spreads do I play on? You could find the ones making the big move. That's the first level. Or simply play the stocks that, even if they're not making too big of moves, if they're kind of even holding a range and they don't move a lot, those are usually the best ones, because then you could get paid on those. But mainly get a high credit. If you could get a high credit relative to the collateral, that's probably the best thing you could do, especially if it's further out the money or has a little chance of getting there. As far as timing now, you want to sell about 2 weeks to 40 days out. This is a common strategy. So a lot of people in the selling premium community, anybody who's sold premium, I know Tastyworks talks about it a lot. They say sell 45 days or less. That's not too bad of a strategy, because the whole idea is get a mix of time and having the odds in your favor. Because even like that Tesla or anything, even my Disneys, I know I'm down on these ones, like I'm down $30 on those, but as you'll see, and I pointed this out on all of the spreads, you'll notice even though they might start going up, they'll start dropping down, and eventually with enough time, the premiums, most of them are going to expire worthless. So that's why less time is good, because if it drops super fast and falls out the money and there's less time, you're going to be able to cap that gain, get all the money, and then go from there. But at the end of the day, you do want them to expire as soon as possible, so you get your collateral back and you're not tied up. And again, it's very, very easy to get tied up in plays by selling a bunch of premium. Your buying power is limited, and then you're going to be sitting there waiting. And that's usually what happens, but it's not too bad. But this is also why I like the credit spreads. This is what I'm telling you guys. The whole point of this strategy, it's going to allow you to sit there, play in the markets every single day. You could even, again, like I'm saying, you're going to be swing trading these. You can make a trade every day if you really wanted to. But the whole point is it's limiting how many trades you could make, even if you had a big account. But the idea is higher probabilities. And by doing that, you're able to play, and then you wait till the opportunity to buy in. And then that way now your account's not dwindling like this until we could hit a moment to go hard on it. So keep that in mind. Next thing is, alongside diversifying, every week find plays that you could sell on Wednesday or Thursday that will expire on Friday for quicker flips that will net you cash. So hopefully you guys are putting, this is what I'm saying, but we're talking, how do you make $100 a day? How do you turn a small amount of money into a large amount safely and not blow up the account? And that's the key. This is the main challenge, is make $150 and stretch it for 3 months and make it last. But at the same time, every single one of these is exposing you to different, we're having different facets to be able to make money. Now this is where you start taking this is more risky. You're taking more risk, but then you find the plays that are going to, you make the play Thursday or Wednesday right before the Friday expiration, and those are going to be a quicker flip. So even if you're only going to get now maybe $10, but some of them you could get $40. We did it on Apple the other day. We made $50 on that one. In the middle of the week, go find plays, or if, let's say, Roku or a stock moves really, really big in one direction, you could either sell it for this week or the one for the next week, but you could find a play. And even then, this is up to you to take, again, how you choose to diversify. You could even go sell it for $5, $10. Go sell a play that's going to expire Friday. Go sell it on Thursday, the day before, collect $10. Boom, nothing happens the next day. There's a cuck, or the stock just doesn't move like it normally does. You make an easy $10. That will start to add up and add up. Again, especially if you guys are here, think about how many weekends you've already spent. If you've been watching us since January, it's been like 30 something weeks or so. Imagine if you were just making $20 every single week off that, your account would have an additional $700, $800 in it. And again, and I'm talking if you're selling super far out the money premium, only collecting $10, $20 or something. So, but again, this is how you're going to set yourself up to collect daily profits, weekly, monthly, all that. And now here's the best part of all this. If any of these plays, regardless of what you're doing, if you lose or are down coming into expiration, you roll it over. And what that means is you close out of the contract and sell the exact same one. If the spread you sold is at a loss, that means the other premiums are up, so you could probably walk away with more cash. So here's an example. Let's see these Disneys. I sold a 131 put and I bought a 129 put. 131 is in the money because the stock is at 130. So again, it's a put. So anything below 130, that person's making money. So I owe it to them, but then I bought the 129. My max risk is that $29. But now let's say come Friday, it's still at this same price. I'll still be down on this, maybe not as much because the time premium will expire. And that's the key to understand here too. We're going to talk about this. Most of the time you're going to hold this till expiration, because even though now I'm down on this play, it says we're down $92 or $34 because we collected $58. The same play is worth $92. It's worth that amount because it's in the money by $100 and there's still a whole nother week left. But now come Friday, if it's at the same price, this contract will be worthless, the one we bought as insurance, but then this one will be in the money by 94 cents. We collected $54 in credit. That'll be a total net loss of $40. So I'll lose $40 come Friday if it stays here. But now here's how you roll over. Let's say it's coming into expiration and you're down on it. Again, most of these contracts are going to expire worthless. So if that doesn't happen in this case, what do? You close out the contract. So we're -1. We would buy that one back. And then we own this one, so we'd sell it. So it's saying a total cost, we would have to spend $92. And again, we collected $58. So it's the same thing. It'd be about the same $40 loss. But now you could also roll over. Let's go to October 18th. Here's the 131 put. Here's the 129. Total cost is $3. So in this case, I could spend $3 more. Our total gain we got was like, what, $58. So if I close this out and spend $3 extra here, I'm going to spend $3, but then this one's going to have pretty much the credit here minus $3 essentially, because remember, we would eat that $40 loss no matter what, and then we're spending another $3 here. This would have higher credit in that case, or you could even switch it around if we really wanted to. Let's say I'm more confident now, I could change up the strike price, or even better, you could change up the dates. I could even go to November 15th if I really wanted to and say, okay, but see, these are whole different strikes right there actually. See, the difference was in that one, now if we go to November 1st, this is a $2 difference, but November 5th was $5 apart. But now you see November 1st, we could sell those, sell the 131, buy the 129, and boom, now I'll actually walk away with a credit. So then we would be taking the loss on the first one, but we'd be walking away with more money. So again, it's pretty much saying an extra credit is going to leave us up with more money. So think about that. You could just do the math right here if you really wanted to see it. Remember, this play, we're going to take a $94 loss minus the $58 we collected. There's that $36 there. But now take a look here. 405 minus 313. We're actually getting $92 in credit. So there you go. That's the whole point now. So it's saying if we roll over, and sometimes now you'll be able to get more credit. It's actually phenomenal. But in this case, we could roll over, and then if we're right, it'll drop, and we'll just make all of our money back and the initial credit we were supposed to make. So we make the money back from the $50 loss we would have took, and we got that initial $50 we were trying to get in the first place. But that's rolling over, and this is, again, why this strategy makes it so safe. If you guys are, all it's going to cost you is opportunity cost and tying up your capital, but at the end of the day, you could waste a lot of time, if you keep rolling over and rolling over longer and longer just to make $50. Sometimes it makes more sense to cut it and move on. But at the end of the day, you do see how you can make more money on this. Now, as far as what not to do, don't sell super deep in the money that have no chance of falling out and winning or leave you with a higher assignment risk. And now understand what the assignment risk is. We're going to talk about that. But what I mean is don't sell super deep in the monies where they're going to offer really, really high credit. So like, again, you saw with the McDonald's, like that 210, that one's super far in the money to a degree, but it's realistically, I sold that with 2 weeks of time to say it's going to move, $3. That's not too bad. But you could see McDonald's in the last month, even off the biggest one of the bigger drops here, it went from what? That's like $10. Surprisingly, that's a big drop. But now take a look here. If you're like, yeah, I'm going to sell, these 202s or these 200, these might be very, very attractive. You're going to be like, yeah, I'll sell the 192 and then buy the 1798. Look at this. You're literally going to make, it's saying $305 credit. You might even get the whole credit of the play, but it doesn't make sense because if anything, you'll get assigned on it, or it's not going to fall out of there. So that's the problem that a lot of people make, is that you got to be able to, determine what's going to realistically hit. And that's why sometimes when stocks do move a lot, sometimes a play could shoot up and get in the money, or if a stock plummets off of bad news and drops $10, it might be in the money, but you sell that, it's a good chance it'll fall right back out. But if you're selling the one super deep in the money, remember, by expiration, if it does not expire out of the money and it's not worthless, there's no real play right there. So that's the first thing not to do. The next thing is start doing all of what I've said here without understanding your full risks and what they are. If you don't know what assignments are, or how the dividends are going to work, or what your collateral is, just watch this video, but watch the other videos we have. Take it slow, come on the live stream and ask questions. But this is a slow strategy to begin with that could lead to surprisingly fast profits. But if you start doing this and you don't know, well, what is a call and put, or why, wait, I don't get how it makes sense that I want the put to, or I want this play to expire out of the money. If you don't know what out of the money is, that's going to be a problem. But, it's only a problem if you were trying to start without learning it, when you could just take a few minutes, maybe a few days, maybe a few weeks to learn it, and it could lead to something that could yield you some good money. The next thing not to do is sell multiple contracts. And that's what people do to get a higher potential gain. This is what's going to make it harder to roll over. It's going to tie up your cash quickly, and it's going to require more collateral, because you're going to sell one of these plays. You could sell this McDonald's, you could sell 4 or 5 of these, but then now you're going to need $200 collateral. And then if the play goes against you and now you're down on it, you're going to have to eat the loss when you could have just rolled it over, got it for a whole nother week, and then let the odds work in your favor again. But that's what happens. Most people, I'm not saying why not sell more? Sometimes you can sell more than one contract. It would make a lot of sense, but in general, start with one. So then that way, if it goes against you, it's super easy to roll it over, and you won't be tied up too heavy in that. The next thing though is that sometimes what people do, they'll go after some of the further out of the money ones that are only paying 10-20% collateral or credit to collateral. So they're taking $100 of risk to make $10, $15, and then they'll sell 10 of them, and even though they have a bigger account, there is $1,000 risk to make $100, whereas, anything could happen. It's not worth it. Even though the odds are in your favor, it doesn't mean you should test the odds. Just because you're more likely to get into a car accident than a plane crash, it doesn't mean you should try to get onto a sketchy airplane and be lighting stuff on fire on the plane while you're there. That's the whole point with, setting yourself up. Just always be safe with this. The next thing not to do is don't constantly try to sell only weeklies or super far out of the money or in the money. So that's the key. So even if you sell the further out the monies, you're just going to make little amounts of money, and it's not even going to be worth it. And you're taking big risk where, yeah, you were right, it's going to work, but it's usually not even worth it. Or if you're selling the further ones in the money, you're only, again, when you pretty much sell right at the money or in the money, like these McDonald's, these are about 30% plays. As you start going deeper and deeper, it just becomes like 2%, 1% plays. But if you're only selling the 30% odd plays, you're not giving yourself time and letting your account supplement those plays. So watch out for that. And then constantly don't sell the weeklies. Don't try to sell on Wednesday and Thursday and let that be the bulk of the strategy, because again, the weeklies have less data. They have less time on them. The more time you sell, the better. But again, find the balance. And then lastly, here's what not to do. Don't cut your losses. This is the key, because some people say, hey, I'm down this much money on this spread. What should I do? This is why you only sell one contract. Even if you sold 2, again, when you sell 2, it gets a lot harder, because you see what I'm saying, the credit to reward. But at the end of the day, your risk is defined. Do not sell a spread if you're not willing to take the loss. And what I mean by that is the collateral minus the credit. So in this case, it's a 210, 212. That's $250 risk minus the 185 of credit. It's a $60 risk. $65. If you're not willing to lose 65 by expiration, don't make the play, because the whole point is you sell the spread and always push it till expiration. That's how the odds are in your favor, because as we said with the Disney, because even if you sold this spread and the stock comes down, even if it closes in the money at 210 or 210.05, let's say 5 cents in the money or 10 cents in the money, even in this case, even if McDonald's went and closed at 211, so it would have closed $1 in the money, so this one still wouldn't be worthless, but it would be at 211. Since we collected $185, this one would be worthless, but the 211 would be worth $100. We still collected 180. We would still walk away with profit. You want expiration, because you sold premium. At expiration, premium is going to be gone. and then all that matters is where the stock is at. So that's why you push it till expiration, and if you're down by expiration, then you roll over. But do not try to cut your losses. Again, the Tesla ones, anything, if it goes against you, know what your max risk is, but you don't just flip it and try to cut losses. The more you move with premium, that's not playing it to your advantages. But that's pretty much it. We did leave a few things out there in terms of the specifics of credit spreads. That's why we have this other videos and all that. But this was really full on looking at the strategy, what to sell and how to sell it. And hopefully you guys have seen, we've talked about the instances of where to sell it, what to do, what not to do, and finding these in the money and out the money type plays. And, again, last time I went over plays, people didn't like it. They said it was a waste of time. So let me see what your guys' feedback is on this. Come on the live stream and see. But try this for yourself. Do it with paper trading. Get a hang of it. Give me questions. We're going to talk about this a lot because this is really what I think a lot of you can become profitable with. A lot of you suck at trading options straight up. It's not your fault. Most people do. It takes time to understand. But again, it's not that you suck. You're just playing the odds against you. Again, the 10% odds, like, when I'm playing those 10% odds, 5%, 2%, and they hit, it makes sense why we make so much money. But you guys need to start building consistency. And then that's the warning. Somebody even said, you're like, dude, I started selling credit spreads because of you a few weeks ago. This is the most consistent I've ever been. Just control your ego. The minute you get consistent, it's easy to start selling more contracts, more collateral, trying to make more moves. Just, don't try to reinvent the wheel. A simple, steady approach could go a long way. And that's why I said, just do the math. A couple $100 a week will really add up in the scope of things. And then you can do a lot from there. So I'm going to leave it at that. Make sure you guys like the video and subscribe. We will see you in the morning, and I'll see you on the watch list tomorrow. Let's go.